Hello, everyone, and welcome to Day 2 of the Manulife Investment Management Regional Investment Conference. I'm Deborah Mao, and I'll be your host for the day. Now, to start us off, we have John Adio, Global CIO for Fixed Income in Boston, and Paul Caligiru, Managing Director and Client Portfolio Manager in the Asia Multi-Asset Solutions team, to talk about global multi-asset diversified income.
My name is Paul Caligiru. I'm the Client Portfolio Manager for our Multi-Asset Solutions team here in Hong Kong. And today we're joined by John Adio. John Adio is our Global CIO of the Fixed Income platform. He's also the primary portfolio manager for this particular strategy that we're going to be talking about today. So maybe just as a sort of getting into it, we can maybe sort of do a 2021 recap. Maybe you can give your thoughts around, which asset classes performed and delivered to your expectations, and then also maybe some asset classes that maybe didn't meet your expectations, and then sort of we can frame that within the GMADI strategy that we're talking about today.
Very good. Well, maybe to set the framework a little bit, as you referenced, this is a multi-asset capability, so it's a combination of bonds and equities with option overlays as well. We use basically option premium to help support the distribution of the product. In the fixed income portion of this strategy, it's a combination of global bonds, investment grade down to high yield, emerging markets and developed markets. On the equity side, it's really a truly global equity capability with a bit of a tilt toward U.S. equities in today's market environment. We can get into that a little bit later. But maybe to your question, I think the idea of what worked and what didn't work, certainly it's been a strong year for equities. We saw a very nice recovery coming out of the depths of early 2020 that continued almost uniformly through 2021. Like any year, there were a few surprises along the way, a few bumps in the road. So we did see some volatility, but general trends in equities were positive. We enjoyed participation in that, so that helped the total return of the portfolio. But as we mentioned, it really is an income-oriented product, so there is a really significant focus on income generation. The high yield portion of the portfolio, and generally we've got a small investment grade exposure and a fairly significant high yield exposure, both in EM and DM, and that's because of that income need. And we all know yields are low globally, and so we do have to work a little harder to find income. But that's really our sweet spot. We think with fundamental credit assessment, we can find good opportunities. The high yield market actually, up until this past week, was the best performing market in fixed income. Surprisingly, perhaps, or maybe not, it was surpassed by TIPS over this past month, where TIPS had an up 2% month and high yield actually was down about 1%, just with short-term volatility, a lot of which came really at the end of the month when we saw yet another COVID variant percolate and really increase volatility in the markets. Maybe an area that didn't perform in line with expectation was EM broadly, and maybe Asia EM in particular. But again, that probably creates a great opportunity for significant contribution to performance in 2022, because we're very optimistic about that part of the market and that region of the world.
Great. So, I think just sort of moving on, I think the elephant in the room and the elephant in the room for many investors is sort of the discussion and the debate around the Fed. Maybe you can give your thoughts around, say we go into Q1 next year and we have, a 6% handle on inflation, and we're not necessarily seeing a marked improvement in the jobs market. Sort of how do you sort of see that with the Fed, and how does that impact markets? And then so the other pieces maybe we can start to sort of bring together around that is, around the global growth profile and how you see that. And how that goes and impacts on rates. And then I think the other sort of element we have this year is the inflation question. Sort of there's a lot of sort of variable parts and moving parts. How do you sort of see that across sort of broad asset classes, impacts on broad asset classes? And in particular, how do you see that impacting, income investing as well?
Great. Yeah, so there was quite a bit there. I think maybe to break it into some of the important components, I would say the inflationary backdrop is one worth consideration and discussion. Monetary policy also very topical and to a high degree linked with that inflationary discussion. Really employment and growth to a degree go hand in hand, but maybe to start there, one of the phenomena that we're experiencing in the U.S. and other markets around the world is the labor participation rate. I think with COVID and some of the behaviors on the part of employees reconsidering job opportunities, contemplating whether they want to go into an office given health concerns, participation rate is down. So the unemployment rate is actually trending lower. We've seen quite a bit of job creation, but we certainly haven't seen massive economic growth coming out of consumer spending. The savings rate is quite high, and I think consumers are a bit cautious. That really does play into inflationary concerns because there are really two important components that we would want to think about. One would be wage inflation, where certainly there is, with a tight labor market, demand for labor is going up. We have seen wage increases in a very competitive job market, which will push wage inflation, and that can be a more permanent form of inflation. Yeah. On the other side, goods inflation for a while, perhaps less so now, but for a while, concern there was more about transitory. We have heard from the U.S. Central Bank that they're probably going to shelve the idea of transitory inflation because with the passage of time, we've realized that inflation is sticking around a little bit longer than expected. So we can either shelve transitory or maybe go back to a more fundamental definition that while it could last for a while, it's not expected to be permanent. That really plays into thoughts around central banks globally and the U.S. Fed in particular, because there's been some testimony over the past several days in the U.S., some of which has created incremental jitters in the market. And it's really about two components of Fed policy. One would be the timing and magnitude of the taper process, and there's certainly a risk that will accelerate. That's actually a positive in my mind because it actually creates more optionality for the Fed in terms of more traditional measures, which would be to raise that short-term rate. One of the phenomena that we saw over the past several days was a flattening of the yield curve, and there was an interesting element to that flattening, something that we haven't seen too often, but it was referred to as a twist flattener, where short-term rates went up and longer-term rates came down. And so generally you don't see both of those happening at exactly the same time, but it's a phenomena that is driven in part by short-term concerns or expectations with regard to short-term rates, and then longer-term considerations around longer rates because of the question around whether aggressive monetary policy might put a damper on global growth. And maybe the last part, I'll stop. You had asked about global growth expectations. Yeah. Certainly, DM is going to grow at a lesser rate than EM. That's not a surprise, but both parts of the market will probably see growth lower than it was in 2021, where we did see really a recovery off a COVID-induced low. But we do see trends continuing positive, and that's actually really a good thing, because when we as investors think about the opportunity set, we factor in certainly economic conditions, broad growth measures, as well as potential growth in revenue and earnings. We also think about technical factors, and we also think about valuation. So the technical factors are pretty strong. The fundamental factors are very strong. The valuation part of the equation is the thing that's in question.
Yeah, okay. So maybe if we can delve into the portfolio itself and the key sort of components that are utilized to deliver the sort of high income. Maybe we can touch on fixed income being the dominant component in the GMADI strategy. How do you see that sort of trade-off in fixed income between, say, as you talked about, sort of a US economy that is fairly resilient, and therefore US high yield can be considered a fairly resilient asset class, particularly when you compare against emerging markets? How do you sort of see that trade-off? Do you see sort of better spread opportunities in emerging markets? There are obviously risks there as well. How do you see that sort of trade-off between the two, and how do you manage that when constructing and making changes to the portfolio?
I think that will be the biggest opportunity in 2022, and it really is driven by the fact that, as we laid out early on, U.S. high yield outperformed emerging market credit in 2021, and it was really driven in part by demand for developed market credit, where both investment grade and high yield is seemingly in the perfect situation where fundamentals again are improving, in good shape. Access to capital is really high, so spreads are tight, and that gets to that valuation question. But the market's been in significant demand, so we've seen a lot of flows chasing those opportunities. Emerging markets certainly is more complex in the sense that it's a broader global market, and there's some regional considerations that we would want to think about. I think when we look, as we discussed, at Asia in particular, spreads are very compelling there. They're by many measures overdone, in great part because of the property sector in China, but more broadly, spreads are really attractive, and in the case of China property, it's really pricing in a cumulative default rate that we've really never seen in credit markets. So that, coupled with the idea that there is a lot of capital in the global marketplace looking for income opportunities, and capital chases opportunity, and therefore it will migrate toward the cheapest markets out there, and certainly EM broadly, and Asia EM is very cheap, and that becomes a self-fulfilling prophecy in a lot of ways, where we see demand for those opportunities, providing liquidity in the market, giving companies access to capital, which can be a big short-term impetus for improvement in spreads. Broadly in emerging markets, the neat thing about what's going on is the underlying cash flow generation in emerging market corporates has increased, and the net debt levels have gone down. So we've seen fundamental credit improvement where spreads have widened out, and therefore that creates a great opportunity. We're fundamental investors, so we're certainly going to look at that at a company level opportunity set, but we think there are some really significant opportunities for both income generation, but also for some total return potential. So the spreads in EM relative to high yield today are very attractive, and if we adjust those, especially in the case of Asia, where it's a shorter duration, higher quality market, credit spreads in Asia could be 60 to 100 basis points cheap relative to high yield, and therefore that represents a really compelling opportunity for us. And that would be the balance, I think, to your original question, this idea of how do we shift between emerging market and developed market. It really is, again, at the security level as a starting point, but the attractiveness of segments of the market, either at the sector level or at the regional level, is going to really target our analysts in a direction where they can find company level value.
But just sort of moving on to the equities component of GMADI, I mean, equities is the sort of second pillar of the portfolio, and obviously the fixed income piece is there to really generate that income and generate that yield, and then we look to the equities to maybe generate some capital appreciation. How is the sort of equities performed over the year, and what sort of areas are we looking at in terms of sort of themes? I know this is not a thematic portfolio. We're looking for yield and dividends, but sort of how is that portfolio sort of constructed, and how does it look currently? And going forward, again, how are we going to be positioned, do you think, into the next year?
Yeah. So maybe starting at a very high level, I would say that the tilt today is a bit more toward U.S. than non-U.S. equity exposure. So it's probably in the neighborhood of 75% U.S., 25 non. It's really got a large cap blend tilt to the portfolio. We did earlier in the year shift a bit away from global, more toward U.S. for a couple of reasons. I think confidence in the rollout of vaccines was a big factor. The idea that a bit more growth orientation was playing out and more in favor than the more value-like tilt of the global equity exposure that we had. So we made a shift there. To your point, I think it is expected to generate total return. It's got a little bit of income contribution. The yield is a bit less than 2.2 on the dividend yield of the equity component. So we do get some income there. But I would say that the exposures are not surprising. I think our largest sector exposure is technology, a bit over 20%. We've got 17 or so in consumer non-cyclical exposure, and then the next big one is financials, where certainly the rate play would be at work there, and that's actually a good defensive mechanism against the rate sensitivity of the fixed income portion of the portfolio. It's I think Steve Medina, who's our global equity CIO and has a big influence on the equity exposure in the portfolio, would tell you it's kind of an eclectic exposure. It really has a fundamental orientation. It's got representation of all of the the large cap tech and consumer and communication exposure that you would expect, appropriately weighted. This is I think to the management of risk in the portfolio, it's a lower beta capability. We're really not trying to knock the lights out on the upside in the portfolio with that income orientation. We want to be participatory, and I think we did. If a day or two ago the equity portion of the portfolio was up around 20%, that's pretty close to that 0.8 beta relative to the market, up 22 or 23% year to date in terms of some of the equity indices. So I think we're doing really well there. It's really a nice balance. Right now, if we think about the fixed income sleeve being about 50% of the portfolio, the equity and option sleeve is the other half of the portfolio today.
Thank you, John. I think we're in a fairly decent position to continue to capture higher yields in this particular strategy. When yields do go high, given the sort of the high yield component of the GMADI strategy. Thank you, John. Thank you for your insights, and thank you today for joining us from Boston. And thank you all our viewers as well.